Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
All right. Welcome to the Gentle Art of Crushing It podcast, Passive Investing Edition. My name is Randy Smith, and I'm the founder of Impact Equity. And our goal here is to educate and inspire the passive investor as they either continue to or start their journey from traditional investing over to passive investing. We have got an awesome show here today. I'm super excited to have Aileen Prak on the call. Aileen, welcome.
Thanks for having me, Randy.
Awesome. Yeah, kind of a funny story. Aileen actually interviewed me, I think it was about a week after I had been laid off from my W-2 job. And it was an exciting podcast nonetheless, but Aileen is just a force in this space and has done just a ton of work. So super excited to have her share her experience with the audience and help bring some value to help the passive investors. So Aileen, to kick this thing off, I'm wondering, can you kind of walk us through your journey up to and what you've been doing in the passive investing space?
Sure. Thank you. So my passive investing journey really started when I got pregnant with my son back in 2018. As we become parents ourselves, we start to look for ways to be able to protect our time with our kids, create other sources of income in case of emergencies or things that are happening beyond our expectations or out of our control. Similar to what happened to you, like being laid off, that was outside of our entire control. So what we wanted to do was protect ourselves on that side of things. So in case something were to happen, we still had income coming to be able to support our family, our growing family with our son and everything. So we started the journey of looking for different opportunities and different ways to invest. And we live in California, and we were actually looking for ways to invest in California, maybe doing a house hack or buying a duplex or, a 3 or 4 unit property and rent out a couple of them, live in one. However, that didn't work out for us. So we ventured outside of California. And through that journey, we invested in some single family outside of California before we stumbled upon this world of multifamily. Okay. And when we found that completely changed our view of what true passive investing was, and that journey and what we actually thought about it. And so we dived into that, educated ourselves before we actually jumped in to invest as passive investors.
Okay. So so the audience that we have listening with us is everything from brand new investors, actually probably a bunch of folks that haven't been investing at all. So you mentioned a couple of phrases. I'm wondering, can you walk through house hack? Because I think that if I had it to do all over again, house hack is definitely the route that I would go. So I'm curious what your thoughts are on that.
Yes. So house hacking, what it really is you're basically taking the current houses that you have, or you're just looking for a way to generate additional streams of income with the house that you already live in. So you would live in, the concept is if we were to buy a duplex, so that's 2 units, we would live in one, use that as our primary residence, and then we would rent out the second unit. And the whole entire goal is, you would live there and somebody else is paying the rent and essentially covering the mortgage that you're paying for that house, and you're generating income and some cash flow through that process. And so that's in a nutshell what house hacking is.
No, thank you. I think it's interesting when I look at the appreciation and the value of prices that have gone up. It's so difficult for college students getting out of college, or even the younger generation trying to buy that first home, that it just becomes, it's not even an option for most people unless they start looking at some of these creative options. So thank you for walking me through that, or walking the audience through that. Now, you mentioned a little bit about looking out of state. And I suspect you started doing that because you couldn't cash flow properties in California. Is that kind of what happened there?
Absolutely, absolutely. That
Okay,
coupled with the fact that we were getting outbid because it was so competitive here.
sure.
So we weren't getting the cash flow we were looking for. We couldn't win the deals. So we started looking outside of California because you're able to generate cash flow. California,
Okay.
you're not looking for cash flow. It's more of an appreciation play typically.
Got it. Got it. Okay. So when you're looking, what type of markets did you look at? And did you actually buy any single families out of state, or did you just look
We
at those for a
did.
while? Okay.
We did. So we looked at single family homes first because that was all we really knew is single
Mhm.
family homes because that's, everybody buys a house. Everybody knows how to buy and rent out a house. And so when we were looking outside of California, we were looking at just stable markets that were just generating cash flow. So the rule of thumb at that time was to look for something that would create like a 1% rule. So if you were
Mhm.
able to, put down a certain down payment and the cash flow that you're making off of that should be close to 1%. In this day and market, it's going to be a little bit tough to find that, but we were trying to get as close to that percentage as we could. So
Yeah.
just looking for different deals outside and then got into a couple of single family homes before jumping into the multifamily larger apartment space.
And what markets did you jump into then with the single families? I'm curious.
So we were in St. Louis, so
Okay.
in the Midwest.
Okay. Yeah. So St. Louis is a high cash flow market. It's not necessarily an appreciation
Yep.
market, which I think is important too. My wife and I, we bought in Kansas City and we bought in Atlanta. Kansas City, probably more so cash flow. Atlanta ended up being an equity play. But it's interesting. There are some markets that kind of have that sweet spot. So I'm curious, after acquiring a few of those, after you had some time under your belt, what type of cash flow per door or per unit or per house were you experiencing, say on average, on an average year per month?
So per month, if everything went perfectly as planned, we were making about $300 to $400 per month on those properties.
Okay, so the pink unicorn of $300 to $400 if everything's perfect. So how often did it go perfectly, would you say?
It was going very well. So in the first year, but then COVID had hit and we got into the whole, the renters were not paying.
Sure.
We were getting behind on rents. There was some issues with the house that we had to put in and maintain. And so the added cost of renovations and maintenance on that had essentially kind of wiped out a lot of the cash flow that we had generated throughout the entire year.
Yeah. Yeah. I had a similar experience. I had a couple of months that went really well, but I think the handful of years that we did it each year, there was a fairly significant loss, is what my experience was. And it's possible that I just wasn't a good operator in that space. Because I do know folks that generally they grow wealth very, very slowly in that space and a little more consistently. But that's interesting. It sounds like you and I had kind of similar experience there. So
Yes, especially in the beginning because it was our first investments outside of
yeah,
state. So we were still brand new to the space and learning at the same time. And
sure.
so what we found was the property manager, especially if you're an out-of-state investor, is so crucial. If your property manager is not up to par with
Mhm.
communications, with up to speed with everything and on top of what the needs are with the tenants, your needs are as the owner, it's the communication kind of falls apart and it's
Yeah.
really hard to operate it if you don't have a really strong property manager.
I think it's a really good point. And it's interesting when you look at it at the loyalty of the property manager. You would like to think as the owner that you're the primary customer, but their primary customer really is the tenant. And their goal, as it should be, make sure the tenant gets a good property, gets repaired quickly. But at the end of the day, they are a profit center as well. And property management's generally low margins. So you can end up getting nickel and dimed just on
Mhm.
routine maintenance calls, actually routine maintenance that sometimes they just throw on the calendar because it's the fall and we like to clean the gutters or something like that. And next thing you know, your property manager is making a lot more than you are on the property you've got 20% down on. So interesting. Right. Okay. So at some point, you guys make the decision that maybe single family is not the way, and you start looking like so many folks do at multifamily. So talk to me if you can a little bit about what did that look like? Why did you choose to go down? Were there some certain influences maybe that kind of pointed you in that direction? I'd love to hear that piece.
Yes. So what we started doing was looking at other different models and started to network with other people in real estate. And what we stumbled upon was the term syndications, which in all simplicity just means a group investment. So we're able to pool together our resources in terms of capital, knowledge, resources, experience to be able to purchase these larger apartment buildings, which are considered 5 units and above, and purchase something that you wouldn't necessarily be able to purchase on your own. And so we really like that model. And what really drew us to multifamily was the way that it was being valued compared to the single family space. Where a single family space, if you were to buy, let's say, a $200,000 home, which I'm in California, you're not going to get that, but sure. in other places, you might be able to find, $2,000 home. So if you have a $2,000 single family home, your next door neighbor is going to be worth $200,000 as well, something close to that. Yep. Imagine if that neighbor, though, had a default on their loans and now they've bankrupted and now the bank takes that property. That value of the house has now dropped significantly. Your house that you own next door has also been impacted based off of whatever happened to your neighbors. Yep. And so that was important for us because when we found multifamily, we realized that you could actually, they're not valued the same way. You can have two exact or similar types of multifamily properties right next to each other, but they are valued completely differently because they're not based off of the comparables, the market comparable. They're actually being valued at the net operating income. So how much profit are they generating? How much income are they bringing in into that property? And based off of that, one property could be operating way more efficiently than the neighbor's property, and it's valued at a much higher value. And we're able to do this thing called forced appreciation, where we're able to, go in, renovate the properties, improve and bring up the rents to more market value. And that's going to impact directly your bottom line, therefore increasing and forcing the appreciation onto that property.
Love it. Thank you. That is just a perfect explanation of the difference between the two. I spoke with another investor yesterday, and the actual practice that he uses is he will take paint and he will take a portion of his parking spaces on his apartments, and for a couple $100, he will add 50 spots and put the word reserved and charge a $50 premium per month for reserved parking, which he spent $200 on the paint, but he increased the value by tens of thousands of dollars just by spending a few hours painting some parking lots. So it shows the power of that forced appreciation, which you so eloquently explained. So thank you for walking us through that. So multifamily can be extremely powerful, but it's a big business as well. So did you guys jump right in and go out and buy a 50-unit apartment in Dallas, Texas, or how did you guys get into the space initially?
So no, we didn't do that because one, we didn't have the experience, the network to be able to do something like that. But what we did do was we started to educate ourselves by listening to podcasts, reading books, started networking and going to meetups and trying to figure out this syndication multifamily space and what was this all about. And first of all, thinking to ourselves, is this too good to be true? Is the sponsor going to take our money and run away with it if we invest with something like that? And so it was just really trying to figure out, the space, the lay of the land. So once we did that and, our parents had ingrained to us, get a solid foundation, because once you educate yourselves, you can do a lot of things, but get that solid foundation first. So that's what we did.
Okay. So education breeds confidence, which breeds the ability to take action. So you mentioned podcast, you mentioned networking events. Are there any particular groups that you leaned on most when you first got started, or was it just kind of anything and everything you can get in front
It
of?
was anything and everything because at that time, me and my husband, we're still working our full-time W-2 jobs.
Okay.
And at that time, we were also still commuting very far, very long hours. Like my commute would be 3 hours back and forth
Oh my
from
goodness.
my workplace and sitting in traffic in California traffic. And so during that time, I would just consume content through podcasts, just like yours here, and just trying to educate ourselves and just listen to them. And then from there, gain the confidence to be able to understand it. And then not necessarily go out and purchase our own like 50-unit apartment, but what we thought was fantastic in a way that kind of followed our model of investing and our conservatism is let's partner with an operator or someone who's already experienced in this place and lean on their knowledge and their expertise to guide us. And so we jumped in as passive investors first, just to have that proof of concept to see, is this really true? Does this model, is this viable? And does it meet our expectations?
Okay. So let's talk, if we can, a little bit then about your journey in selecting that first partner. Because like you said, I think back to that first wire that I did, and I went down to the bank and my banker was telling me all the scary stories about people intercepting your emails and sending you all the wrong information, and that somebody's going to run away with my money. Talk to me, if you can, about how you got comfortable with, one, finding that operator, and then two, actually pulling the trigger and wiring that first 25 or 50 or $100,000.
So it's all about the due diligence and getting to that comfortable level. And we were listening to a bunch of podcasts, and we'd actually heard this sponsor on multiple different podcasts. And so that was a great, powerful way to already get a feel of who they are as a person, what are their values, what's their background. So when you reach out to have a conversation with them, you already kind of have a sense of familiarity with them. And so from there, it was just confirmation. Having that conversation was that confirmation of, is that person who they say they are, or who we believe them to be through their podcast and through all the research that we've done on them.
Yeah, no, I agree with you 100%. Like a couple of the operators I work with, I've listened probably to, 30 or 40 hours of these guys over the course of years. I feel like they're good friends of mine. I might have only talked to them for an hour or an hour and a half, but I feel like I know everything I can possibly know about them. It's just a really good way to build trust and faith in what they're doing, and know, like, and trust, right? The goal of all of those. So, okay. So I know you've invested in a handful of properties, both passively and actively. I'm wondering if we could spend a little bit of time and talk about like favorite asset classes and why you favor those maybe over others. And if you have any kind of fun strategies that you use to diversify across different types of investments.
Yeah, certainly. So our main focus, and when I say our, it's me and my husband because we invest together. So our main focus is multifamily and self-storage. And there's so many different fantastic asset classes within real estate. But for us, we didn't want to get the shiny object syndrome and just try to catch everything as possible because we can get distracted. So our focus is multifamily and then self-storage on the as a side as well, because they're very similar in types and how they're structured and how they're valued. And so they kind of go very well hand in hand together. So those are the two ones that we focus on.
Okay. And I'm wondering, I focus quite a bit on those two as well. A lot of talk lately about the stock markets and where the economy is going, and how does real estate fare during recessionary times or drops in the economy? Do you have any thoughts or ideas or comfort level in sharing anything in that space? Or
so with the stock market, I personally have never really been too invested in stock markets. I'll do the typical, the 401k, invest in those plans with the employer and everything like that. But I never really got into like my own stock investing on the side and really interested in that, because for me, that was out of my control. I didn't really 100% understand it. People just said, put it into a diversified fund and you should be okay, like over a certain period of time. So I'm like, okay, I'll do that with my 401k or like, an employer matching or something like that. But it just didn't make sense to me. And so when we found multifamily and syndications, that model made sense because you're able to have somewhat of a control over the value of it. You have, if as a passive investor, you can talk directly to those sponsors and the operators who you're working with, who are directly impacting the bottom line and bringing up the value of your properties. Within stocks, I wouldn't be able to call up the CEO and ask them, "Hey, why are the stocks down this month or this, today or something like that?" I wouldn't be able to do that. But with syndications, you're able to talk directly to the sponsors, and that gave me a really good comfort level as a passive investor to really know who the people are who's actually managing my money, and the model itself made sense to me. And so, in multifamily apartments, there's always going to be people. There's always going to be a need for people to have a place to live. So the need and the demand from apartments are never going to go away. And so that for us was really important to be investing in something that the demand is always going to be there. And so it is one of the most recession resilient asset classes to be in.
Okay. Yeah, no, I like that. I love your point about communicating with the operator. When I look at my stock portfolio from this year, from all of those years, and all of my money that I have in the stock market is from retirement plans that I've had in the past. And that actually is shifting now that I have left and I can transfer some of that. But the opportunity to reach out and have a conversation and, see the operators actually talking and sharing what's going on with the business plan was new to me. And I'm curious what your take on that is. From a passive investor, do you regularly reach out to your operators? Are you comfortable, or do they get annoyed with you reaching out, or what does that look like for you? Because I'm the guy that possibly has too many questions sometimes. So I'm curious what your thoughts are.
So especially in the very beginning, when you're still learning, the learning curve is very high because you don't know what you don't know. So you're going to have a lot of questions to the sponsor. But at the same time, once you pull the cord and you decide to make that investment, you have to know, like, and trust that person is going to take care of your capital. So you can ask the questions, but I would just be respectful of their time also. But, of course, I would always want to work with a sponsor who is open and has an open door communication where I can feel comfortable enough to reach them. Because for me, transparency and communication are so important. And if there's a sponsor who gets annoyed with me communicating or asking my questions, it's probably not the right fit for me. So I would just move on and pass and continue to vet other sponsors, because there's so many deals, so many sponsors out there. You're not married to just one. You can diversify across sponsors and markets and everything like that.
Yeah, really, really good point. Yeah, and I'm the same way with my investors. And with the syndicators that I work with, or the funds that I work with, I have most of them on my phone, text them. I text one operator that I work with quite a bit, and he literally responds within minutes. It's amazing to me. These are real people, just like you and I. Actually, you and I are involved in the space and accepting stuff like that. But these are just real people that are running a business. They're family people. They have things outside of the investment world. And I'm wondering too, if maybe we could talk a little bit about that, because I know in our conversations, you've talked about reasons why you looked at real estate investing and some of the benefits and value that it's brought to your family, and some of the options and choices that you have now in front of you because of that. I'm wondering if you could talk through that a little bit.
Yes, of course. So by investing in real estate, you're taking back control over your finances and where your income is coming from. As W-2 employees ourselves, we love what we're doing. We love what we're working and being an employee for somebody else. However, even though we feel that comfort level that, hey, we're getting that paycheck in every other week, we're getting that biweekly check-in and it's consistent. However, at any time, situations could change, things that you're not aware of, the company's need might shift, and your job, your loyalty to the company might now go away because the need is no longer there. And so even though we love what we're doing, we always want to protect ourselves and look at the risks that are involved there and see how we can minimize and mitigate those risks. And how do we do that? And we do that by looking for different ways to create passive income for ourselves so that we can generate enough passive income to cover our expenses in case something like this were to happen, especially with a growing family. You need to support yourself and your family. You never want to be caught in a situation where you don't have any backup, and now you're scrambling and just taking anything that's not in the best interest of you and what you want to do. And so for us, it's given us a lot more choices, and it's given us a lot more comfortability. And, we get to choose now to continue working instead of we have to work to be able to make ends meet. We get to choose to, continue on in our W-2 jobs because we have that passive income coming through. And we're able to couple those two together so that we can expedite our journey within real estate and passive investing.
Awesome. Yeah, very well put. When you reach that first level of financial freedom where all of your expenses are covered from your passive income, it's an amazing feeling to finally hit that. And very well my experience getting laid off. It was the same thing. Most of my colleagues that were laid off, they were struggling and scrambling to go out and find that next W-2 job. And fortunately, because of 3, 4, 5 years of this, I didn't have to do that ourselves. So the benefits of passive investing, or real estate as a whole, really gives those type of benefits and confidence that you can make the decisions that you need to for your family. So, well, I feel like honestly we could talk for another hour, but I want to be respectful of your time and the guest time. But I do have a few questions I'd like to run through pretty quickly, if we can do those.
Yeah.
Can you list a favorite book or a podcast that's been very powerful for your education process?
Yes, especially as a passive investor, Brian Burke has this hands-off investor book that really outlines fantastic details for the passive investor in terms of like syndications and what all that means. So that's the one I always go to.
Awesome. Yeah, literally step by step, every phase of the process. Here's what to do, how to do it. Very good. Yep. How can our audience support you?
So they can also check out our podcast as well. We do educational base as well. It's called How Did They Do It Real Estate.
Awesome. And is that focused on all different types of real estate, or?
Yes. So we are very similar in terms of we're looking to just inspire and to educate and just share the stories of how powerful real estate can be through the stories of our guests.
Awesome. And great podcast for those of you listening. I've listened to a ton of those. Any final thoughts that you'd like to leave with the audience?
So when you're looking to get into passive investing, educate yourself first. But once you get to a certain point where you've done enough educating yourself, you need to take action. So you have that education and you're able to take that smart, actionable steps to get you to your next goal.
Love it.
And don't get bogged down by just one opportunity and feel like that's the only one that's going to come your way. Look at all the risks that are involved, make sure you understand it. And don't be afraid to walk away from a deal. There's always another one around the corner.
Absolutely. I think 90% of it is making a decision, because there are so many different ways you can be successful in this space. It's just making the decision and moving forward. You can always pivot. So, and then finally, kind of a fun one. What is a recent bucket list, and what is a new bucket list item that you, or maybe not new, but one you are shooting towards?
So you mentioned it earlier. We have hit and released our 500th podcast episode. So that was one of my bucket list items.
All right.
And so the next one that we're looking to hit is 1,000. So that'll be the next one. Yes.
it was great at 500, but let's double it, right? So, and I think do you do like one a week? Or one a day, one a business day?
Yes, 5 times a week.
Okay. So if you're doing, goodness, that is a lot. So that'll happen in what, 2 years, I'm guessing?
Yes, about 2.5 years.
All right. Well, we'll be listening and learning right along with you. So, well, thank you so much for joining the podcast today. I learned a ton of it. I'm sure that our guest did as well. We certainly will put your bio and all of the information to contact you in the show notes. But thank you so much for joining us today. And we look forward to connecting with you again in the future.
Thank you so much for having me, Randy. Appreciate it.
All right. Thank you.
Well, there you have it, ladies and gentlemen, another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.